You did mention ESG. Now, I mean, this seems like
don't get me started.
A cavalcade of
Mike. I would have thought you were Mr. ESG.
Oh yeah, I'm also very politically correct.
Yeah, I just failed a while ago.
You have to leave 2 progressive countries so that he can speak behind.
I love ESG. I just would like to know who's E, who's S, and who's G.
Well, I totally agree with you there.
Like to espouse, and once we identify that, then of course you can do it. I think Notre Dame has done a wonderful job, and Notre Dame in their investment endowment has espoused an E, an S, and a G that are very congruent with a certain religious Catholicism, which makes perfect sense. I understand that wonderfully.
As a failed Catholic.
Yeah.
The left's Catholic.
Aren't they all? Aren't we all? It's all built on forgiveness. Anyway, the point is, how do you, until you can get to that group that you identify with, this is really hard because you need to identify very specifically who you would like to identify with in those ESs and Gs. And so that's where it falls down for me a little bit. It's not that it's not a good thing. That's just my philosophical issue.
You're totally right? The problem with ESG is it's packaged products, right? Packaged products are the worst way to implement ESG, except for every other way that we've had pretty recently, right? Because, literally in the ETF space, we have the Catholic Values Fund and the LGBT Fund, both classified as socially responsible investing. Obviously, those 2 portfolio managers would not agree when they got into the same room.
Yes.
But as an ETF nerd, I basically have to say, these are both values-based
investing. Exactly. It should be VBI.
We should start a values-based ETF company and have choose your own values.
Your values.
What you're talking about.
Your IPS. Your IPS would be values. Are you a monk?
Are you a monk? Do you believe in women's rights, even male rights?
Are you a monk? Probably gets narrow real tight.
I don't know. I'm into bald male rights. Are you into or what?
Yeah, the fund for me, the head polishing fund.
I think we'll get OAUM on the bald rich white man category. Probably. I don't know if you're gonna. That'll sink the whole.
But but this is the problem of ESG. It has been a big year for ESG. It's been, double the flows we've had in any year in ESG ETFs. If you actually layer in under mutual funds, it's even more, right? So it's definitely not a fad anymore. There's hundreds of billions of dollars showing up in these strategies. Again, led by institutions. That's where all this started. Because like you said, people like Notre Dame can articulate a mandate very clearly and have the assets to be able to say, you manager, go run this strategy for me. That's where ESG ends up. I think ESG is what cracks direct indexing open for the average investor. Certainly firms like Parametric and Optimal, they've built whole businesses on this already, whether they called it for ESG reasons or not. But a lot of advisors I've talked to, they actually are approaching this from a 2-pronged perspective. The 2 biggest problems they have, some guy walks in who's a Google executive, but wants to be passively invested. And now you've got to figure out how to get him into a bunch of index funds that don't have Google in it. Good luck with that. And chances are he's probably not going to short Google to get it out of his portfolio, because when that shows up on the PR, that's real bad. So solving that problem, what do? You get in the S&P 500 -1. Very easy to do in a direct indexing platform. The other thing it lets him do is say, and I don't want to own tobacco stocks, right? And then he can just say, okay, it's S&P 500 -3. That's super easy. And there are a lot of platforms building there. Canvas from O'Shaughnessy Asset Management is probably the one that I think is getting the most attention or traction with a certain class of, billion plus FinTwit advisor. But I think that is the future, and it becomes the future really quickly once folks like Schwab bolt that into their fractional share program. And now all of a sudden everybody rolls their own index.
And I think there's a
category. Are these advisors can plug into these platforms and choose categories for their clients? So 500 minus type of.
There are quite a few platforms that do this now. O'Shaughnessy's been pretty out there on financial Twitter about it because that's sort of where they are. But like Just Capital has been doing this, Ethic Invest, Open Invest. There's quite a few of these platforms sprouting up right now.
You know, it's very interesting in this world of protecting your 1% to become the ethical advisor where you're paying them to make sure that you go to heaven rather than hell. Maybe
this is the point.
That's brilliant. Like that's just another angle, another marketing angle.
Also, well, the interesting thing about this angle, and this is where like who's E, who's S, and who's G. If you can actually customize that to the point where you can make it bespoke for the individual, you now truly have an ESG, and you have, I think, an extra layer of defense against behavioral vulnerability.
Yep.
Because if I am, if I'm part of a tribe, that even gives that extra layer. But if I've articulated a level of values, now I'm not beholden to performance vis-a-vis an index of ruthless capitalists. What I am is I'm a thoughtful investor who's decided on how I might invest ethically and am willing to suffer the slings and arrows of whatever performance cometh, because I will only invest in an ethical manner. So you get this extra layer of, I think, behavioral attenuation if you can actually deliver an ESG that is totally customized to someone's value set. I think it grows in power exponentially if you can attach it to a group, obviously, because then you have a group of people who are supporting one another in whatever the performance would be, outperformance, underperformance, and whatnot. But I think
it's fantastic because what it means is that there's an entire new cohort of investors who are non-profit seeking. So they're willing losers from a profit seeking perspective, which means that, hey, maybe factor investing might experience a renaissance. You know, there may be some nickels lying around for passive indexes or active indexes.
I thought I was in the role of cynic, but okay.
No, it's like I'm gonna blow a.
I've been encroaching on that for years.
I'm gonna pop your bubble on that because what we've seen recently is that probably since the Volkswagen blow up, most of the data being used to drive ESG portfolios, and I'm not saying this means it's ESG. I'm saying most of the data being sold to people implementing ESG strategies, which means it's coming from usually Sustainalytics or MSCI. If you actually use that data, it turns out to be, whether it's useful as a social tool or not, it turns out to be a pretty interesting risk management tool. And that's really where this has started to raise. It's like the average ESG fund has beaten the crap out of the average non-ESG fund so far this year. Now, the reason's fairly straightforward.
A bit of a self-fulfilling prophecy, I think. Right?
No, it's because the current crisis we're in has crushed energy, transportation,
how are the airlines doing,
and manufacturing, right?
Are we getting back to cascading effects?
Yeah.
Are you pro cascading effects again? Look, so one of the interesting discussions between it's really what you're saying is the ethical versus the alpha, right? And so I was at an alternative conference recently with Kaysa Depot was saying, look, we're going to become much more prone to look at the ethical nature of how you invest and the funds. But there's a big, we have constituents and we have, our goal is to provide a certain level of return in alpha. And so we have to put these two things together, this idea of excess returns and ethical investing, and ensure that we're meeting our ultimate objective, which is to provide real money to our constituents at the end of the year. And so what's more important than that to our constituents, and what's actually the goal of what investing is about? It's a tough debate, and I would lean towards make the money, right?
Well, it depends.
You capitalist pig.
Depends on your mandate, right? Like, so I'm an Episcopalian, and I am very tangentially touching some of the folks that do the Episcopal endowment management and all that stuff, and it has a bunch of ESG stuff in their investment mandate. They, low carbon, all that kind of stuff, which sounds like, because I grew up in the 80s, that sounds like I'm giving something up. But increasingly, what we're seeing is that doing something like using the input of how exposed somebody is to weather events, that's actually risk management. That's whether you care about the environment or not, you can't argue the frequency of high impact storms from an economic standpoint has gone up. So that is a data set You can argue about why. I'm not here to have a political argument. I'm just saying I have a bunch of data that
But
suggests
shouldn't the risk premia associated with
Exactly.
those companies that have that
They
risk
should be high. They should earn a
increased
higher return.
if
well,
if
they
it's in markets
will
or-
because they're being priced down, right? So if you assume that they're managing those risks well and that there's not a chance they're going to have a dead year because they were exposed to a bunch of weather events and all of their refineries went offline, then sure, if they
Okay,
manage that
okay.
well, they should earn a huge excess return. But currently they're priced as if those things basically never happen, right? So very few companies are correctly priced for their exposure to weather. I would argue some ags are pretty well, like soybeans respond pretty damn well to weather forecasts, right? Because
So I'll grant you
soybean
some of
traders
this,
have been
Dave,
looking at that
but
for
I do think
decades.
it's a bit of a slippery slope, right? Because it's just really easy to build an index that expresses biases that you can position as, for example, anti-carbon companies have performed better than carbon-heavy
intense.
companies over the last 10 years or over the last 15 years, but really it's just because they've been energy light and energy is underperformed. You know, like it's really easy to create narratives to support a values argument and
But my
sell
point is you don't have to do any of that. My point is you can using divorce yourself. You can be an automaton and approach this from a big data perspective. I have 4,000 inputs. I'm going to mine that data to see what's predictive of standard deviation in my stock price, right? Totally standard big data thing to do. If you chose to do that and ignored intentionally everything around board diversity, everything around governance standards, everything around regulatory play ball, everything around bribery statutes, everything around energy. It's like if you chose to ignore every one of those data sets, which is now publicly available and 10 years ago was not available at all, you would be in violation of your fiduciary duty. Like these are important data sets about risk parameters that you have to at least test.
No, I absolutely agree with that. We've got new data sources that provide completely different dimensions of risk on individual companies. They should absolutely be factored in, but I don't think that's quite where ESG goes, right? ESG is not factoring them in with a profit incentive. They're factoring them in order to be able to express a set of values or create a narrative around expressing a set of values to appeal to.
It's an ESG bug, not a feature, right? It just that's the side effect of what. It's not what they cared about. It's not what they wanted to do. But all of a sudden, alpha generators have access to this database that ethical managers are not using it for that purpose. You talked about standard deviation around certain features. That's not what they're doing. They're using it to become a better ESG fund for their constituents. But it's been a byproduct of that has been that everybody else can benefit from better information.
It's been a bonanza for people who want to data mine a strong an index with strong historical performance that also they can spin a great values story around, as cynic would say. You know, like you could certainly.
But again, does it matter whether you're a cynic or not if the end result is you've generated better risk-adjusted performance for your client? And what I'm saying is there's an increasingly large body of evidence that whether or not you give a shit about anything, pardon my French, if you are simply trying to generate a lower standard deviation, higher alpha after, that ESG is a pretty damn good way to do that. Like when I started doing ETF analysis 10 years ago, I was building this data set for ETF.com. We put in a measure of risk adjusted alpha because it was like, oh, okay. And literally no smart beta fund, no actively managed bond fund, which is all we had then. None of them generated out of the 1,200 funds we were looking at in 2010. Not one of them generated risk adjusted alpha over 3 years or longer. Not that surprising. It's a tough thing to do. You look now, almost every ESG fund does on a 3-year basis.
So don't they load on quality and low vol?
Well, that's not what they intend to do. What they intend to do is look at things like board diversity and carbon impact, et cetera, et cetera. Those tend to be, whether they are whether they're important or whether they're proxies for other things being managed. Like diversity in a workforce and board diversity, I think, are one of those things that are canaries in a coal mine. And I tend to be getting political, I tend to be pretty left of center. That's like fine, whatever. And I know that's not the same with everybody else, but regardless of that, dismiss all of that. Having a reported highly diverse board implies certain things about how you're managing the company. And it's the implication that's actually important. The having one other voice on the board, I don't actually believe is the thing that made your company perform better. But the fact that you made a point of doing that probably implies you're listening to your employees more than you would be otherwise. And that listening turns out to be a risk management factor. That would be my argument.
You got the result team speechless.
I think it's an interesting.
I think that's fine. At the end of the day, if we go to 2008 when oil and agricultural are ripping, you can go do your analysis then and tell me how that works for you.
You can't.
The
data did not exist.
The same. The thought of having some ethics would exist, and if you had done that, you are a loser. Amazon doesn't do anything. Nobody does anything. Agrium, Potash, Exxon is the largest company in the freaking world. All of the data that you would have mined to support the case in that slightly different time frame would have invalidated this if the idea is that we're going to provide excess returns.
There's a reason why ESG is coming about right now, and it's not just the political climate. It's also because the quality low-vol companies that typically are included in ESG indices have outperformed for 10 years.
Yes.
And if in a different market,
is it correlation or is it causality?
Yeah.
I mean, it's true. I remember when Mike was talking about the commodity crisis, my Wall Street moment was being in the muck in Toronto during that massive commodity boom. And there was a fund that whose benchmark was the Canadian S&P TSX 60. And it was a long-only equity fund that charged 2 and 20. And it was crushing that benchmark. And why it was crushing that benchmark is because it was 100% energy and mining and potash.
Yeah,
Was that Rohit's fund?
It was not a little bit of alpha. It was just massive. But when you compared it against, well, my whole shtick was, okay, cool, they're beating the S&P, but compared against the commodity index, and they're underperforming, right? They're still underperforming a passive index, which you would enjoy. But at the time, if you're an ESG fund, or let's say somebody creates an anti-ESG fund during the 2000 to 2010 period, they would have crushed the ESG funds in your model, right? It's a lot of correlation. And the causality. You convinced me on the causality. I'd love for that to be true.
But
I did a thesis in college on that same thing: quality management, quality board. See how the profitability was of the organization, and there was a correlation there. We saw that. So I'm kind of with you. But I also see the other side.
Let's go back to this people hurting and the convexity issues here. Regardless of whether any of us is right in our argument on either side of this, and the people in chat who are violently disagreeing with us, doesn't actually matter. I'm totally fine if everybody thinks I'm a moron. The problem is flows are suggesting lots of other people think this way too. So whether you buy my argument or not, let's again bring it back to what are we doing for our clients? What are we doing as investors? If going forward, more and more people are going to be including these values-based decisions in their investing, what should you do as an investor? Now, if you believe this is a short-term flash in the pan that will disappear in 16 months, great. Take the counter on it. We have $30 trillion in assets being handed down from people who are average age 75 to who are average age 45. That group, average age 45, also called millennials, you look at the surveys on that, they are off the charts on their desire and expressed interest in values-based investing. And that's a question we've been asking since the 70s, and no generation has ever pulled anything like this one. Now, skeptically, you can say, yeah, until they lose money, blah, blah, blah. However, it doesn't mean that they handed this money over
the outside view.
But
I don't know that that's the skeptical view. I think that's the outside view. Show me some people that want to lose money. But at the end of the day,
the point is they're not.
The millennials might.
they are the market, then this will
The
come.
millennials might accept that they think that Tesla, that Elon Musk is a god that's going to save humanity, and therefore their ethics go all to
Out
him.
the window.
No, but they're making money. They haven't lost it yet.
Exactly.
You
That's
know what
my
I mean?
point.
Like,
But it's like this is my point about things like Tesla.
Oh.
It doesn't like whether I like Elon Musk or not has
Agreed.
no bearing on anybody in the universe. It's
What's
just
the
a question
core-
of whether or not I believe other people are going to like him so
See,
much that they bid
No, I
his
get,
stock
hey,
up.
you're up in my Keynesian beauty contest now.
See,
Like
that
I
is-
am
that's- no one here.
100% with you. I have one algorithm we need to solve. How do you make one good drink and then not have to just drink straight bourbon after because your cocktail is done? Give me that
Somewhere
algorithm.
near you got to get
If you
dinner.
don't mind, can you get me that algorithm of how I get a second
The
drink?
My wine was done 10 minutes into this, so I've been thirsty for.
I know, me
15
too. But that's why I brought the bottle of bourbon. I thought I gotta have a fallback.
Exactly.
For what it's worth, just to cap ESG, because bourbon's actually an interesting case in point, right? I'm not one of these people that believe that like alcohol stocks are going to go down because so many people don't want to drink booze. Like I'm a realist. Like, I live in the real world, right? So the idea of like sin stocks and non-sin stocks, like if that's how you want to invest, that's great. That's awesome. But I'm only trying to figure out what do I think the mass of people are going to do. And I genuinely believe that there is a mass of people who are going to care about social issues, governance, and global warming.
Marijuana stocks.
And whether or not you believe in that or not doesn't matter. If more buyers of stock believe
What do you
that,
think about marijuana stocks in the US?
there are no marijuana stocks in the U.S.
I'm talking about the future.
Not the real ones. No, Canadian small caps for the win. Of all think local.
Think local.
what did MEB launch? Didn't MEB launch a token?
Yeah, CBD stuff. Yeah.
Oh, it's CBD.
No, there is
CBD.
now. I don't know much about it. There is now an ETF in the U.S. that claims to only invest in U.S. listed legal cannabis adjacent companies because there is no actual publicly listed cannabis
pharmaceutical
company in
companies. It's the new
the US.
pharmaceutical.
A lot of dancing to make your index work.
Yeah.
Is that
Cannabis
That's
adjacent.
really-
I've never heard that before, but I like it.
Yeah.
Hilarious.
I agree with you,
Well-
by the way, that it is like that whole ethical theme. I just can't go anywhere without hearing about it. And
It's
Yeah,
I hear from
yeah.
advisors everything.
but what's happened is it used to be like a year ago. It was okay, great, let's invest in your stuff. Looking at, oh, by the way, do you invest in any of that sin stuff? Oh God, no. We use futures contracts, so it's got nothing to do with it. Oh, okay, great. Now it's becoming part of like questionnaires, and it's just going to get more and more stringent from there.
We have a great
doubt that it just goes bananas from here.
There's a great question in chat, which I want to actually address, which says the question becomes how long investors or corporations will tolerate underperformance in the future when it happens versus politically correct images or beliefs.
Preach.
I think it's a false premise. It doesn't.
What?
Well, because I actually don't think they're like let's just take one small issue. Let's just take board diversity. And let's narrow it super down. Like, do you have a woman on your board? If that became the rubric by which people allocated capital, then companies who put a woman on their board will do better as a class because they'll get more capital. Like it's a self-fulfilling
that's true at the margin, but there are much larger forces at play. Like the point I think we were making earlier, right, is this is all well and good until there's a fundamental shift in the macro dynamics. So if we go into an inflationary environment and commodity producers are again driving index gains, then typically commodity producers are not known for their diverse boards and wanting to promote women and minorities, but they are going to completely dominate, and there will be a reversal where a lot of these sort of tech-oriented companies which thrive in deflationary growth environments like we're currently in will move towards the bottom of the heap. You'll get 5 or 10 years of underperformance.
That's not how ESG money is being allocated.
By the way,
ESG money is being allocated based on minimum variance. So if you look at the things that have actually pulled in money, it's things like S&PE, which is the S&P 500 sector balanced, kicking out, I don't remember what it is, like 25% of the company.
It allows for the fact that in a gold and precious metals index, there are There are just less women that are employed in the mining industry and then have the opportunity to bubble up through to the directorships. And thus, anyone who has more, if you have a woman or more, you will have more representation in that index. Is that sort of what
That's
you're saying?
my point, right? And that's, you look at S&P E and E5, which State Street just launched, and their whole shtick is we're just starting with the S&P 500. We all agreed those companies should be there, and we're going to sector balance them. So if energy is 10% this year, you're getting 10% energy. But the 10% energy you're going to get is going to be the one that scores highest on carbon mitigation, on how they're handling.
So now we're back to, that's fine, but now we've compromised our values, right? That's fine. But
No,
are
it's
they
fine.
values or are they?
But all these things
I like
are
that a lot
margin,
better.
man. They're
I
all
like that a lot
margin.
better.
I like it better too, but if I had values, I wouldn't.
But you don't.
I don't have values, so I just don't care.
We've long
If I
established
had
this.
values, I would be like, I don't want that.
Right.
Just
Well, we'll
some
make a special
demented-
Mike index next.
Well, that's a whole different
Like,
ballgame.
didn't you profit? Remember CalPERS back in like the late 90s? When was it that they kicked out Philip Morris tobacco stocks, and then and it just blew the earnings yield on tobacco stocks to the moon, and anyone who was able to take the opposite side of that was just made out like
retail investors who probably, still hold, in my retail career back then, those investors still hold that Philip Morris, and they've done very well by violating their values.
Well, and it gets to the point of like,
other people's values.
Yeah.
Yes.
Well, but I think this does get to the point of like how much are people willing to vary from the market to express these opinions, and
Correct.
the money has all shown up in strategies that vary very little from the market, right? They improve their ESG scores by 20%. They go from a 50 to a 70. It's not that they all become saints. It's just that they incrementally do a little bit better because, again, the math is showing that actually reduces your portfolio volatility and doesn't impact your returns.
If I'm a gold stock CEO,
Can we control for sector?
No, we don't. That was a different type of value, but that scores high. The point is that if I am a competitor within the gold space and gold is killing it, the first thing I'm going to do is make sure I tick off the first 10 boxes of whatever the most ESG Venn diagram is.
the whole point.
Or whatever was influencing capital. Like my stock ticker needs to start with a C. Okay, I changed the name of my company. You do what you need to do to make that change.
Yep. That's fine. I think that's a much more enlightened view from the perspective of asset owners, because the portfolio manager gets to claim the optics of ESG without really compromising any of the profit-seeking values that they are actually accountable for as a fiduciary.
One of our portfolio managers at Resolve just, Ani, why don't you put up her comment there? I 100% agree. If you see it there, hashtag women in finance. There we are.
Yeah. So this is a really
We scored huge on our ESG on Resolve. Guys, allocators, listen up.